In 1957, a small group of Soviet bankers did something almost nobody in Washington noticed. They moved $800,000 out of an American bank account and into a Soviet-owned bank in London. That's the entire event. No headlines, no emergency meetings, just a wire transfer made quietly out of fear. That single transfer created a financial system that today moves more raw dollars around the planet than the entire domestic United States banking system holds within its own borders. A system the Federal Reserve does not fully control. A system most finance ministries cannot precisely measure. A system almost nobody has heard of. Even though it quietly underwrites nearly every dollar transaction on Earth that doesn't happen inside America itself. It's called the Eurodollar System. And despite the name, it has nothing to do with the euro. Say it out loud and it sounds like it should. It doesn't. The euro didn't exist for decades. Euro here just meant somewhere in Europe, not America. A casual habit that later turned a dollar deposit in Singapore or the Cayman Islands into a Eurodollar too, despite being nowhere near Europe at all. Here's why this matters right now, not just historically. Every few months, a new headline claims the dollar is dying. BRICS wants its own currency. Central banks are buying gold again. Countries are quietly trying to trade around Washington. All of that is true to a point, but almost none of it touches the actual machine keeping. The dollar in charge of the world, that machine isn't run by the US government at all. It's run by private banks operating far outside America, creating and trading dollars the Federal Reserve never printed and does not directly oversee. Most people arguing about the dollar's future have never heard of the system actually holding it up. So let's build it from the ground the way it was actually built. Picture a Soviet bank in the 1950s holding dollars inside the United States. Reasonable position for the time. This is the world's reserve currency, except the Soviets had a problem. If Washington ever froze Soviet accounts over some Cold War dispute, that money could vanish overnight with a single signature. So Soviet bankers did something clever. They moved the dollars into a Soviet-owned bank in London instead. On paper, almost nothing changed. The dollars technically never left American banks. They were simply redeposited through a London institution, which meant they now belonged legally to a British registered entity instead of directly to Moscow. Same dollars, different owner of record, much harder for Washington to touch. There is something almost funny about this. The Soviet Union, sworn enemy of Western capitalism, quietly helped build one of the most important instruments of that same capitalist system, purely to protect itself from it. British banks noticed something else entirely. American banking rules at the time capped the interest banks could pay on deposits. A rule called Regulation Q. London had no such cap. So London banks could offer better rates on dollars than American banks could legally offer on their own currency. Depositors noticed, borrowers noticed. Within a few years, American banks themselves started opening London branches just to get around their own government's rules on their own currency. By the early 1960s, 9 American banks were running Eurodollar operations out of London, holding several $100 million between them. By the end of that decade, the market had grown to roughly $70 billion. The market kept compounding through the 1970s and into the 1980s, spreading beyond London into Singapore, Hong Kong, the Cayman Islands, and Dubai. By 1981, it had grown so large and so central to global interest rates that the Chicago Mercantile Exchange launched a dedicated Eurodollar futures contract. Just so banks could hedge it, the first cash-settled futures contract ever created. A market that started almost by accident, out of Cold War paranoia and a dusty banking regulation, had become large enough to need its own trading floor. Here's the simplest way to picture what actually happens inside it. Say you lend your neighbor $20. You don't hand him a suitcase and stand over it. You just agree he owes you $20, and that promise functions as real money because everyone trusts it will be honored. Now stretch that same idea across thousands of banks in dozens of countries, in the trillions, with almost nobody checking the paperwork in real time. No actual dollar bill crosses an ocean. What moves is a claim, an entry on a ledger, backed ultimately by an account still sitting inside the American banking system, but now owned, tracked, and lent out entirely outside it. That, at its core, is a Eurodollar. Then, in 1971, Richard Nixon severed the dollar's last tie to gold. Bretton Woods, the post-war system pegging currencies to the dollar and the dollar to gold, collapsed. You'd expect that to weaken the dollar's grip on the world. It didn't. Global trade still needed dollars to function when OPEC nations began pricing oil almost exclusively in dollars through the rest of that decade. Every oil-importing country on Earth needed dollars regardless of what Washington's own monetary policy happened to be doing, and the Eurodollar market was the fastest place on the planet to get them. No permission required. By the mid-1980s, there were more Eurodollars circulating outside America than actual dollars circulating inside it. Now, here's the uncomfortable math nobody puts on a headline. Ask a simple question: how big is this system really? You'll get an uncomfortable non-answer. The Bank for International Settlements currently estimates something like $13 to $14 trillion in identifiable Eurodollar positions. People who study this closely will tell you quietly that number is a floor, not a ceiling, because a large share of it lives off any single government's books entirely, layered through derivatives, repackaged through collateral that gets relent multiple times over, tracked by nobody's unified ledger. This is a market larger than most national economies, and no one, not the Fed, not the BIS, not any single government, can hand you its true size with real confidence. That uncertainty isn't a footnote. It nearly broke the global financial system once already. Heading into 2008, researchers later estimated the world was short somewhere between $2 and $6 trillion of dollar funding this offshore system was supposed to be quietly supplying, and simply wasn't. Nobody had measured that gap in advance because nobody was formally responsible for measuring it. When the shortage hit, it landed as a solvency crisis wearing the disguise of a liquidity crisis, and the institution that ended up plugging the hole was the Federal Reserve, wiring close to $600 billion overseas through emergency swap lines. Two foreign central banks, just to keep functioning a market it does not officially regulate and had never fully mapped. Sit with that for a second. The most powerful central bank on Earth had to quietly rescue a trillion-dollar market it doesn't actually run, because letting it fail would have frozen global trade within days. Now compare that to the story most people are actually being told. The popular narrative says the world is de-dollarizing, that gold purchases and BRICS summits prove the dollar's reign is ending. Here's the irony sitting underneath all of it. Even countries actively trying to escape US political leverage are still functioning inside a private offshore dollar credit system that doesn't ask Washington's permission to exist, doesn't wait for US policy, and keeps expanding regardless of who's angry at whom. You can hold a press conference about abandoning the dollar. Meanwhile, your own banks are still borrowing, lending, and settling trade in Eurodollars because there simply isn't a deep enough alternative sitting ready to replace it. The dollar isn't dominant because Washington willed it. It's dominant because private banks operating outside Washington's reach keep manufacturing the plumbing the entire world quietly depends on. Ask which currency a Brazilian exporter uses to price soybeans sold to China, or which currency an Indian refinery uses to buy Saudi crude, and more often than not, the answer still runs through Eurodollar accounts sitting in London, Singapore, or Hong Kong, not a single dollar bill printed by the United States Treasury. And that plumbing keeps showing cracks. In September 2019, an ordinary combination of tax payments and treasury settlements drained cash out of the banking system faster than anyone expected. Overnight lending rates, which normally sit around 2%, briefly spiked toward 10% within hours, not because of a crisis anyone saw coming, because the system had almost no slack left in it. The New York Fed had to step in fast, pumping tens of billions of dollars a day just to calm a market that, on paper, was supposed to be routine and boring. 6 months later, COVID hit and the same offshore dollar funding market seized up again, forcing the Fed to expand its emergency swap lines once more just to keep dollars moving to the rest of the world. Zoom out and the picture gets uncomfortable fast. $13 trillion. The conservative estimate is larger than the annual economic output of every country on Earth except the United States and China. And it's on a foundation of trust, ledger entries, and the quiet assumption that someone somewhere will always answer the phone when the music stops. The global economy runs on a currency system with no single regulator, no complete map of its own size, no formal lender of last resort obligated to save it, and a track record of nearly failing every decade or so. It keeps getting rescued quietly by a central bank acting outside its own charter because the alternative is unthinkable, and every time that rescue happens, the market doesn't shrink out of caution. It grows because everyone now assumes the rescue will always come. That assumption has never actually been tested to its limit. So the real question isn't whether the dollar is losing its grip on the world. By most evidence, it isn't, not yet. The real question is what happens to a financial system that nobody designed, nobody fully counted, and nobody formally guaranteed if the one institution quietly holding it together ever decides or is forced to stop.